In this week's video, we'll cover a NASDAQ signal that's only occurred 3 times in the last 25 years. We'll talk about why the signal is relevant to the bigger picture, what it says about the stock market's risk-reward profile over the next 5 years, and ask and answer. Is the never-ending long-term pessimism supported by the signal and the weight of the evidence? Explore whether this signal aligns with or contradicts the secular bull market thesis, what it says about the theory of a technology-driven productivity boom, and whether or not the signal supports the demographic evidence that we've covered in these videos numerous times. We'll start with the relevance of the signal. The chart on your screen shows New York Stock Exchange new 52-week highs minus new 52-week lows. The chart is dated August 30th, and we covered it in the September 1st, 2023 video. Clients and regular viewers know that we've been talking about concerns related to stock market breadth for some time. We've been saying over and over again that we'd like to see it improve. And as you might imagine, the signal that we're going to cover dovetails nicely with this topic. In the ETF world, everybody knows SPY. It's the S&P 500 ETF, the largest S&P 500 ETF. And both SPY and the S&P 500 are capitalization-weighted indexes, which means larger companies like Microsoft carry a bigger weight in SPY and the S&P 500. Contrast that with RSP, the equal-weight S&P 500 ETF, where you take all 500 stocks and equally invest in them. Same exact stocks, 500 stocks here, same stocks here. The weightings are just different. Equal weight, concentrated, or capitalization-weighted ETF. And this is the index version of RSP, the S&P 500 equal-weighted index. Chart on your screen dated October 27th, 2023, just a few short weeks ago. The chart shows calendar year 2023. This is January 1st over here. This is October 27th in the lower right-hand corner of your screen. On October 27th, the year-to-date, the typical stock in the S&P 500, the equal-weighted version of the S&P 500, was down 5.46%. And the majority of the returns in SPY year-to-date came from 7 stocks that are often referred to as the Magnificent Seven: Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, and Meta. Having a relatively small number of stocks influence the return in the S&P 500, the standard weight S&P 500, and SPY is really nothing new, really nothing odd about it. That's just the way capitalization-weighted indexes operate. The concern about this topic all year, and why it was concerning on October 27th that the equal-weight S&P 500 was down almost 6% year-to-date, speaks to margin of safety and probabilities. Common sense tells us that if the stock market returns are being driven primarily by 7 stocks, and that's happening in a context where the other 493 are losing money and or are in jeopardy of flipping over to long-term downtrends, that tells us at some point something has to give. Either these 7 stocks are going to roll over and everything is going to get back in alignment, or we're going to have a market that, for the most part, is a ticking time bomb. Because if 493 stocks are in downtrends, that tells us something about expectations related to earnings and the economy. So on October 27th, RSP, equal weight S&P 500, down roughly 6%. The slope of the 200-day moving average in red is rolling over in a concerning manner. And if we're looking at the 20-day in green, the 50-day in blue, again, the 200 in red, prices below all of them, the slopes are down. We've got a full-bore bearish look for RSP on October 27th. And that means the margin of safety for these 7 stocks and the margin of safety in the capitalization-weighted ETF, SPY, that margin of safety is shrinking. Another concerning factor on October 27th was RSP, the equal-weight S&P 500 index, was also breaking down in a bearish manner from a 9-month consolidation box. So on the daily chart, it broke below the box and then eventually went on to print a lower low. And when we have 493 stocks, in theory, starting to roll over, not only is that concerning about the margin of safety, But at that time, on October 27th, we have some pretty significant evidence tied to 493 stocks that contradicts the bull market thesis. And that's why we're saying we'd really like to see this improve. It needs to improve. Think of it this way. If RSP is clearly in an uptrend, the equal weight S&P 500, and SPY is clearly in an uptrend, they're in alignment. There's no divergence there. That's normal. It's common. It's not uncommon. But when they start to diverge, it tells you the risk-reward profile of the S&P 500 and SPY are starting to deteriorate. So on October 27th, this look as well needs to improve to get back in alignment with the weight of the evidence. Just as RSP was struggling on October 27th, our accounts were also struggling on October 27th. And if you've been following your account, you know that it's improved significantly over the past 8 weeks, and that's also the case with RSP and the equal weight S&P 500. And that's good news, because ultimately this is a story about market breadth and participation. On October 27th, 493 stocks, somewhat concerning relative to year-to-date participation. Fast forward to the present day, things look better. And the topic speaks to the sustainability of the bull market. On October 27th, we've got RSP that's coming off of the bear market year in calendar year 2022. And then in 2023, it's down year to date. That's not particularly encouraging, especially when you keep in mind RSP and the equal weight S&P 500 index are the exact same stocks, the exact same 500 stocks in SPY, in VOO, and in the capitalization weighted S&P 500 index. Since we don't own an ETF tied to the NYSE composite, let's look at similar breadth data tied to the S&P 500 or the 500 stocks in RSP and SPY. On January 1st, 2001, new 52-week highs minus new 52-week lows sitting at this level here. And during a counter trend move in the financial crisis bear market 2008, the level right here. New 52-week highs minus new 52-week lows. And from a risk management perspective or a margin of safety perspective, that's relevant because in both cases, any counter trend moves were followed by significant additional losses. .com bust bear market case from this point here, S&P 500 lost an additional 41.17%, and the drawdown after this counter trend move that ended in mid-May of 2008 was very painful. An additional loss in the S&P 500 index of 52.58%. Thus, it becomes a little bit more clear why we've been showing this here and why it was concerning that RSP was down approximately 6% just a few short weeks ago. Because during these counter trend moves in the .com bust bear market, breadth never can clear important hurdles, and after that, there's a lot of pain. Same can be said here in 2008. So if we look at this level and this level and we compare it to 2023, we didn't clear these two dotted lines here until June 16th, which speaks to margin of safety. Thus, for our confidence to increase, we'd really like to see this data get above the blue line, and we'd really like to see the data get above both of the dotted lines. And as we mentioned, we did that on June 16th. And if you're a client, you may remember from about mid-May to June 16th, we increased our allocations, our exposure to risk, because the evidence, the weight of the evidence was improving. If you jump the gun here in 2001, the additional loss in the NASDAQ 100 was over 65%. And in this case, if you jump the gun in May of 2008, the loss in the S&P, NASDAQ, and NASDAQ 100, all of them approximately 50%. So on October 27th, we know we still haven't cleared this hurdle, still haven't cleared this hurdle. And we know what can happen when you've got a market that's got very narrow participation and it starts to break down. Thus, we needed this to improve. We needed to see evidence of improvement, and thankfully that's happened over the past 8 weeks. And if we check back in on this data, for the first time in calendar year 2023, we were able to clear the blue line on your screen, which means we were above this level and we were above this level, lowering the probability that something like this or this was going to happen. And when we finally clear the blue line on December 13th, just a few short days ago, now we start to look like June 6th of 2003, something similar happened, or October 14th of 2009. And the good news is 6/6/2003 is after the major low. It's in the context of a new bull market. And October 14th, 2009 is after the major low and in the context of a new bull market. So when you look at this figure and you look at this figure and you take into consideration that primarily we manage people's retirement savings, you can begin to understand why you're taking a measured approach in calendar year 2023. And that was the case until very recently. And we still need to hold this look. But it's a step in the right direction. Thus, some fair questions in the context of 2023. And we'll answer them in the historical context. Does taking a margin of safety approach mean you will miss out on the opportunity for additional gains? We just said that what happened on December 13th, finally clearing this level here, was similar to June 6th of 2003 and October 14th of 2009. Thus, it might be helpful to know, how did stocks perform walking forward from those two dates? The answer is extremely well. Average return looking out 5 years, 55%. NASDAQ 100 performance here, average return looking out 5 years, approximately 92%. Telling us that during calendar year 2023, taking a margin of safety approach and respecting that until the evidence improves, something like this and or like this could still happen, didn't mean in any shape, form, or fashion from a historical perspective that the opportunity was in the rearview mirror. To the contrary, the next 5 years walking forward from June 6, 2003, and the next 5 years walking forward from October 14, 2009, were extremely bright and sunny. And those tables are based on something that just happened on December 13th in 2023. Thus, you can make an argument, given the look of this trend on October 27th, and the fact that the last 2 years for the equally weighted S&P 500 index on October 27th were not particularly satisfying, the 493 stocks may be ready to join the Magnificent Seven in a more sustainable bull market with a much more favorable margin of safety. The signal we're about to cover is tied to market breadth, and it's relevant because it tells us we're in a logical progression of a bull market. We've taken the next logical step from a breadth perspective, which doesn't predict anything. It simply speaks to the probability of good things happening relative to the probability of bad things happening. We should keep in mind, technical analysis can't predict the future. It helps us assess probabilities. And more specifically, it helps us assess what the actions of some traders may say about the future actions of other traders. Some traders were able to push market breadth from down here in 2001 to this level eventually in 2003. And that's a shift in their conviction about future economic, market, and earnings outcomes. A similar shift occurred between Q4 of 2008 and Q2 of 2009. Same can be said following the COVID low in 2020 to this point here. So we're down to a rare oversold level in 2022, the green line. The only other times we've made it back to the blue line, 2003, 2009, and 2020. It's relevant because we've been saying for quite some time that we need to see market breadth improve, and it has. Now let's ask and answer, what does it say about the stock market's risk-reward profile over the next 5 years? In the historical cases, after a similar A to B move, really good things happened. Average return in the S&P 500 5 years later, over 65%. Even better for the NASDAQ Composite Index. Average return 5 years later, over 85%. And even better for the more narrow NASDAQ 100. Average return 5 years after the date of the signal, over 100%. telling us that the never-ending pessimism is not supported by the historical evidence after similar signals. And the signal aligns with the weight of the evidence that says the bear market ended in Q4 of 2022. Since the CCM market model uses a weight of the evidence approach, let's cover some additional and extremely positive developments that occurred between that October 27th low and December of 2023. We're looking at the 8-week moving average of the NYSE breadth thrust indicator. It's extremely rare. In fact, it's only happened one previous time that the 8-week moving average gets this oversold, this pessimistic. Q4 of 2008. Then the early adopters, those traders, push optimism back to these levels here. This speaks to a significant shift in expected outcomes related to the economy and earnings. We got back to the green line in the first case, May 1st, 2009. Very similar to what happened between this point A and this point B, and this is December 19th, something that happened a few short days ago. Thus, it's helpful to know. In this case, what the past actions of some traders told us about the future actions of other traders was extremely positive. And we talked a few weeks ago about what could happen, take the pressure off interest rates and the pressure off future government bond auctions. Answer was an improvement on the inflation front. That's exactly what we saw this week when PCE data was released on Friday. So something that we can see, measure, and put in a model that just occurred on December 19th represents a significant improvement in market breadth, something that we've been talking about really for all of 2023, something that we would like to see happen. And it makes very favorable comments about the market's risk-reward profile over the next 5 to 10 years, and it really doesn't support the never-ending pessimism about debt and the recession that's always right around the corner. And under our approach, we want to prudently put our capital in harm's way when the odds are in our favor. And we have to be willing to move capital out of harm's way when the odds begin to deteriorate. And thus far, we've shown, at least from a historical perspective, that taking the attitude in 2023 that if this indeed is the early stages of a new bull market, history says there should be plenty of time to make money, additional money, in addition to what was made in 2023. In the 2009 case, when the similar signal was fired, the additional time, over a decade. Continuing with the weight of the evidence approach, let's look at the NASDAQ 100 breadth momentum oscillator. We've got data going back to 1999. We're looking at all the data. Only one previous time has the oscillator moved from the red line back to the green line. Came very close to doing it after the major low, the COVID major low, but didn't quite get to the levels that we saw here and or here. So this point here, very, very similar to December of 2023, and in the historical case, good things happen for a long period of time. This is the NASDAQ 100 breadth momentum oscillator. Now we'll look at the S&P 500 breadth momentum oscillator. What did the past actions of some traders say about the future actions of other traders? In the historical cases, said something very, very positive. Average gain 4 years later in the S&P 500 index, over 60%. Now moving on to a breadth indicator that's tied to common stocks that trade on the NYSE. Only have data, in this case, going back to 2003. It's rare to be in this oversold area down here near the green line and then make your way back to the blue line. But that just happened between this low here in 2022 and December 20th of 2023. Now that's good news, because in the historical cases, every time the S&P 500 was higher, average gain over 16%. How about Dow stocks greater than their 150-day simple moving average? Remember earlier we said the next logical step, you can see the breadth indicator exceeded the levels from earlier in 2023. Why is that relevant? Because after the major low in 2002, you made it back to the blue line. After the major low in 2008, you made it back to the blue line. After the major low, COVID low in 2020, you eventually made it back to the blue line. We had not done that yet until December of 2023, the next logical step. And in the historical cases, really good things happened looking out 1 to 4 years in the S&P 500. Average gain 4 years later in the NASDAQ Composite, almost 80%. Average gain in the NASDAQ 100, which is similar to the triple Qs in the ETF world, 83.14%. NASDAQ 100 stocks greater than their 50-day simple moving average. A similar A to B move, we're up here, this chart is dated December 21st, was followed by very satisfying gains in the S&P 500 index. The NASDAQ Composite with an average gain 4 years later over 50%. And the more narrow NASDAQ 100, average gain also over 50% looking out 4 years. S&P 100 stocks greater than their 150-day simple moving average. The past actions of some traders said a lot about the future actions of other traders following the date of the historical signals. 4 years later, average gain in the S&P 500 almost 67%. It's a loud chart. S&P 500 greater than our 50-day exponential moving average, going back here to the end of 1999. And we're looking at hurdles after major lows. 2002, 2008, 2010, 11, 2015, 2018. Moral of the story, probability that the low is in increases each time you get above one of these dotted blue lines. This is where we are here, up at 90%, December 20th, 2023. This is where we were just a few short weeks ago. And that's relevant because when you're up here, that tends to be during bullish periods. And when you're up here, that doesn't correlate very well with bearish periods. Red boxes down here, S&P 500 index. Concerning look in the year 2000, concerning look in 2008, an improving look in 2022 and 2023. Updated the secular volatility model during the session on Friday, December 22nd. Results favorable. Top 3 scores, all of them speak to the vulnerability of a significant drawdown within the context of an existing secular trend. This vulnerability score here in October, concerning, hovering right around that 55 to 45% range. Score which ranges between 0 and 100%. The current score of 99% tells us that we look like one of the stronger portions of a secular trend during a rally portion, a bullish period. And we really don't look like we're susceptible to a significant counter-trend move at this point. These figures down here say we're not particularly susceptible based on what we have in hand today to a 5% correction, a 10% correction, 15 all the way out to 50. If these numbers start to get larger, the probability of a pullback starts to increase based on the data that we have in hand. They too fluctuate between 0% and 100%. These models are based on human greed and fear, which really hasn't changed at all. In the secular bull period between 1950 and 1968, it also includes the horrible bear market that follows, the secular period between 1982 and the year 2000, a very bullish period, and the horrible bear market that follows, and the current secular bull market with discernible improvement starting in 2011. If you're a stock market bull, you want high scores up here and low scores down here, which is exactly what we have on December 22nd. The improvement that we've seen in RSP tells us that the probability of extremely bad things happening, like a bear market in the Magnificent Seven, is lower today than it was a few short weeks ago. The same can be said for the capitalization-weighted version, or SPY. The margin of safety has improved, telling us that based on what we know today, we should be able to let our accounts swing a little bit more freely. And given that, for the most part, 493 stocks of the 500 stocks in the S&P 500 on average lost money during the bear market in 2022, and they were still down almost 6% on October 27th, 2023. If you weren't particularly happy with your account's performance in October, you were probably not alone. Thankfully, RSP and the equal-weighted S&P 500 index have improved significantly over the past 8 weeks. We've been saying we needed to see stock market breadth improve, and it has. All of these signals that we've covered are based on market breadth, and they're based on significant and observable improvement in market breadth that historically was followed by extremely satisfying gains for patient investors. It's very, very easy to understand how investors were discouraged on October 27th, 2023. And we're still at the stage of a bull market where it's not unusual for investors to either switch methods, switch gears, or just throw in the towel altogether. The look of this data here in June of 2023 told us it was still prudent to take a measured approach because we had not cleared hurdles from a probability perspective to eliminate this type of outcome. And based on something that just happened a few short days ago, clearing this second major hurdle that occurred on December 13th, it's very easy to make the argument that this is the exact wrong time to throw in the towel. Because as we've demonstrated via numerous signals, you can make a very rational argument that the bull market is just starting for those 493 stocks in the S&P 500, and that increases the probability greatly that the bull market will continue for the Magnificent Seven and for SPY, the capitalization weighted version of the S&P 500. The green tables speak for themselves. And there's no question that the signals that have occurred in recent weeks align with the secular bull market thesis. And as we said back in June, in this window here before the secular bull ended, the S&P 500 gained an additional 142%. In the 82 to 2000 bull market, still had over 400% of gains in front of it. Not a prediction in any shape, form, or fashion. The key takeaway is, historically, secular bull markets can last a long, long time. And a common element, favorable demographics. We have them today, and they should improve in the 12-year window that we're in now. Present day similar to the blue box, the green box is coming relative to demographics. You can find more about this topic by Googling the title on your screen. You can find the June 16th video by Googling this title, and you can learn about the secular shift, potential secular shift in interest rates by Googling this title. The weight of the evidence told us in August that the weakness we were experiencing would most likely be followed by new highs. That has indeed happened. The VIX told us when things were looking extremely bleak in October that we should not be betting on a debt crisis or an imminent recession or a return to a bear market. Thus far, that has been helpful. A young and educated workforce that most likely is going to become more productive in the coming years, and a handful of recently fired signals tell us to keep an open mind about much better than expected outcomes over the next 1 to 12 years. The 1982 to 2000 bull market had a lot of technology-driven enhancements to productivity, personal computers, spreadsheets, to name two of them. And as we head into the last trading week of the year and head into Q1 of 2024, our time frame should be years. Where's SPY? Where's RSP? Where's XLK going to be in 3 to 5 years? Not 3 to 5 days or 3 to 5 weeks. The weight of the evidence tells us unequivocally from a probability and historical perspective, there's an attractive long-term opportunity in the stock market. And go look at the volatility of the secular bull market between 1950 and the end of 1968. Look at how far the stock market rose in that period. And it's easy to see that patience and discipline and a tolerance for volatility and a tolerance to let your account swing, all of that was extremely rewarding. I'm guessing a lot of portfolios were completely liquidated, based primarily on frustration in October of this year. The second stage hurdles that were just cleared relative to market breadth, and the fact that the current rally has much broader participation, tells us if we head into next week and every week with that flexible, unbiased, and open mind, we'll be doing so in an environment where the odds are in our favor. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.